This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness. With the people, products, and technology to take you there, it's why they say, at PennyMac, greatness lives here.
Welcome to The Interest. I'm Christine Stewart, and just like everyone else, I'm waiting for the Fed to increase rates by 75 basis points to try to tamp down inflation. Speaking of things that are tumbling, mortgage applications have reached their lowest level in 22 years after falling again for the fourth straight week. Applications fell last week by 1.8% from the prior week. Activity hasn't been this low since February of 2000. An economist for the MBA says the ongoing drop is consistent with data showing dips in purchases for both new and existing homes. On a seasonally adjusted basis, purchase loans fell by 1%. Meanwhile, refis continued to free fall. Refi apps were down another 4% from the prior week and are now down 83% year to year. Increased economic uncertainty and prevalent affordability challenges are dissuading households from entering the market, leading to declining purchase activity that is close to lows last seen at the onset of the pandemic. So it should be no surprise that pending home sales were down in June after a rebound in May. Sales fell by 8.6% from the prior month, with dips in all four regions of the country. The National Association of Realtors says home sales could be down as much as 13% if mortgage rates keep climbing. Sales would then pick back up in 2023. But a silver lining, both the NAR and MBA say rates could soon stabilize. There are indications that mortgage rates may be topping or very close to cyclical high in July. If so, pending contracts should also begin to stabilize. Another silver lining that could bring buyers back into the market. We're also seeing price growth cool. In fact, the median sale price for a new home actually dipped with fewer purchases being made. According to the National Association of Home Builders, the median price for a new home sale was $402,000 in June, down 9.5% from May. Still, that remains 7% above where it was last year. Yesterday, we reported that the Census Bureau said new home sales tumbled in June and were down 17% from a year ago. In other news, Mr. Cooper Group saw its second quarter earnings fall 77% from the previous quarter. The Dallas-based mortgage company reported $151 million in net income in the second quarter, which was down 65% from a year ago. The company announced in June that it was letting go of 420 workers, or 5% of its staff. Despite the drop in net income, the company repurchased $100 million in stock because executives feel the shares are underpriced. And finally, the CFPB and Justice Department are ordering Trident Mortgage to pay $22 million for alleged deliberate discrimination against minority borrowers in the greater Philadelphia area. If the proposed order is entered in court, the settlement would mark the CFPB's first non-bank mortgage redlining resolution. CFPB Director Rohit Chopra said Trident redlined neighborhoods in the Philadelphia area, thus excluding qualified families looking for a mortgage. Chopra also said that with housing costs so high, it's critical that illegal discrimination does not put homeownership even further out of reach. A quarter of the neighborhoods in the Philadelphia area are majority minority, but the CFPB and Justice Department say only 12% of Trident's loans came from one of those communities. If the order goes through, Trident would need to pay more than $18 million into a loan subsidy program, as well as $4 million fine and a $2 million to advertise in redlined areas.
This program was brought to you by PennyMac TPO. Visit tpo.pennymac.com to learn more about becoming a partner and starting your journey to greatness.
For more on these and all of today's top stories, go to mortgagenewsnetwork.com.